They asked the audience to pause for a moment and look away from the price. While most people were watching charts and celebrating rising numbers, something far more serious was happening out of sight. In a single night, 2.7 million ounces of physical silver did not fall in price, did not trade, and did not fluctuate. It left the system, quietly loaded, secured, and removed without headlines or warnings. This was not speculation, and it was not panic. It was a deliberate action. When physical metal disappears overnight, it is never an accident. The real question is not who took it, but why now, and what they know that others do not. Welcome to Financial Explanations. This channel is built for people who have seen markets repeat the same mistakes over many years. If you value understanding over noise, take a moment to subscribe, not for excitement, but for clarity, and let us know in the comments where you're watching from. They were watching the wrong screen. On the surface, the market appeared confident. Silver prices had moved sharply higher, reaching levels that attracted attention across the financial world. Traders focused on charts and technical signals. Many believed the story was about momentum and price strength. For them, the movement on the screen explained everything. But experienced decision makers do not stop at price. They understand that price is usually the result, not the cause. When something important changes inside a market, price reacts later. The first signals appear elsewhere, often in places most participants ignore. While attention was fixed on the rally, a quiet document was released by the CME Group. It was a daily depository report, rarely read outside professional circles. Inside that report was a number that mattered more than any chart. In one 24-hour period, 2.7 million ounces of physical silver were withdrawn from exchange-controlled vaults. This was not paper trading. It was not leverage. It was not accounting. It was metal leaving buildings. In the silver market, this distinction is critical. Futures contracts can be created in large quantities, but physical metal is limited. When real inventory moves, it reflects decisions made by institutions with long planning horizons and detailed information. The price showed excitement. The vault data showed stress. Serious investors study these differences closely. They know that early warnings of market strain usually appear in operational data, not headlines. Inventory changes, delivery requests, and warehouse withdrawals often signal pressure long before prices fully respond. The silver futures market operates through COMEX, where most contracts are settled without delivery. The system assumes that only a small portion of participants will ever request physical metal. As long as that assumption holds, the market functions smoothly. When that assumption begins to change, risk increases. Large physical withdrawals require planning and authority. Trucks must be scheduled, security arranged, and ownership transferred. These actions are not taken by short-term traders reacting to charts. They are taken by banks, industrial users, or institutions securing supply. Timing matters as well. The withdrawal happened without disrupting trading. There were no halts or warnings. Early stages of stress rarely look dramatic. They appear controlled and orderly, which is why they are often ignored. For business leaders and long-term planners, the lesson is not about predicting tomorrow's price. It is about recognizing structural signals. Physical withdrawals reduce available supply. Reduced supply increases sensitivity. Increased sensitivity raises systemic risk. Silver is not only a financial asset. It is an industrial material used across technology, energy, and manufacturing. When physical supply tightens, the effects spread beyond markets into real businesses. Costs become harder to manage and supply chains become less predictable. The removal of 2.7 million ounces does not mean immediate failure. It is not a forecast of collapse. It is a signal that informed participants are choosing certainty over liquidity. Markets often warn before they move. Those who watch only price see noise. Those who watch structure see the warning. The price moved, but the metal moved first. They understood that not all silver is equal. To most people, silver is silver. A metal with a price, a ticker symbol, and a daily chart. But inside the global trading system, silver exists in layers. And the difference between those layers determines whether a market is stable or quietly breaking. At the center of this system sits the exchange infrastructure operated by CME Group. Under its umbrella is COMEX, where silver futures are bought and sold in enormous volume every day. On the surface, it looks like a normal market. Orders flow, prices update, liquidity appears deep. But beneath that surface is the warehouse system. These warehouses are not symbolic. They are real buildings, secured, insured, audited, and controlled. Inside them sits physical silver, bars stacked, sealed, and recorded. This silver is the backbone of the entire futures market. Without it, the contracts would be promises with nothing behind them. The warehouse inventory is divided into categories. The most important of these is called registered. Registered silver is available for delivery. It is the silver that can legally be handed over to settle a futures contract. When someone buys a contract and demands delivery, registered silver is what satisfies that demand. There is also eligible silver. This metal meets purity standards and sits in approved vaults, but it is not for sale. It belongs to someone who has chosen not to make it available for delivery. This difference matters. Registered silver is market liquidity. Eligible silver is private ownership. When silver moves from registered to eligible, or leaves the vault entirely, it reduces what the market can actually deliver. The paper market may continue trading as usual, but the physical foundation becomes thinner. This is where the 2.7 million ounce withdrawal becomes critical. When that amount of metal leaves the system in one day, it is not a bookkeeping exercise. It is not a clerical change. It means ownership changed, instructions were issued, and logistics were executed. Forklifts moved, trucks departed, the silver was physically removed from exchange control. In simple terms, the market lost real inventory. Such actions are not taken lightly. Institutions that withdraw physical metal are not chasing daily price moves. They are securing supply. They are reducing exposure to future uncertainty. They are acting based on risk assessments that look months or years ahead. This is why analysts pay close attention to who can do this. Retail investors cannot remove millions of ounces overnight. Most traders never interact with physical metal at all. The ability to withdraw at this scale belongs to banks, refiners, sovereign buyers, and industrial users with long-term needs. When they act, it signals a shift in priorities from liquidity to certainty. Another important point is speed. Markets are used to gradual change. Inventory declining slowly can be absorbed. It can be explained away as seasonal demand or routine movement. But sudden withdrawals compress time. They force the system to adjust faster than expected. This creates pressure. With less registered metal available, each remaining ounce becomes more important. Delivery requests carry more weight. The margin for error shrinks. The system still functions, but it becomes sensitive to shocks. At this stage, nothing appears broken. Prices may even rise smoothly. But internally, the balance has changed. This is often how runs begin, not with panic, not with headlines, but with quiet withdrawals by informed participants. History shows this pattern repeatedly. In financial systems, stress rarely announces itself loudly at first. It appears as a preference change. Institutions stop trusting abstractions and start demanding tangible control. Metal in hand is certainty. Contracts are not. For business leaders, this distinction matters deeply. Many industries depend on silver as an input. Electronics, energy systems, medical equipment, and advanced manufacturing all rely on steady supply. When physical availability tightens, the impact travels far beyond the trading floor. Supply contracts become harder to fulfill. Costs become harder to predict. Risk becomes harder to hedge. The futures market is meant to reduce uncertainty, but it can only do that if physical delivery remains credible. Every ounce that leaves weakens that credibility slightly. The 2.7 million ounce withdrawal did not collapse the system, but it shifted the balance. It moved the market one step closer to a point where paper promises and physical reality diverge. Those watching only price see strength. Those watching structure see caution. Part 2 establishes a simple truth. When physical metal exits the exchange, it is not speculation, it is preparation. And preparation always comes before consequence. They noticed something else that did not appear on most screens. Prices were no longer speaking the same language. In a well-functioning global market, price differences between regions are small and temporary. If silver is cheaper in one place and more expensive in another, traders move metal. That movement closes the gap. This process is called arbitrage, and it keeps the system balanced. For decades, this mechanism worked quietly in the background. But now it was failing. Across global markets, the price of physical silver in Asia began to separate from prices in Western futures markets. The difference was not minor, it was persistent. And most importantly, it was tied to delivery, not speculation. In Asia, buyers were paying more for guaranteed physical settlement. In the West, futures prices remained lower, supported by paper liquidity. Under normal conditions, this gap would be an opportunity. Traders would buy cheap in one market, sell expensive in another, and move the metal in between. But that did not happen at scale. The reason was simple. Moving silver is not just a trade. It is a logistical operation. Physical silver must be sourced, verified, insured, transported, and delivered under strict standards. When inventories are tight and withdrawals accelerate, the ability to move metal quickly disappears. Arbitrage only works when supply is abundant and trust is high. Neither condition was present. A key reference point for this shift was pricing behavior linked to Shanghai Gold Exchange. Unlike many Western markets, this exchange emphasizes physical settlement. Contracts are designed to result in delivery, not perpetual rollover. This difference matters. When demand rises in such a system, the response is immediate and physical. Buyers must secure metal, not just exposure. As a result, prices there tend to reflect real availability more directly. As Asian demand increased, prices adjusted upward. But Western futures prices did not fully follow. The result was a widening gap between what paper silver cost and what physical silver required. This gap sent a clear signal to institutions. If metal could be withdrawn from Western vaults and moved to regions where settlement certainty was higher, it made economic sense to do so. Not for short-term profit, but for strategic positioning. This is how global pressure builds. Every ounce that leaves a Western vault reduces local supply. Every ounce that arrives in a high-demand region reinforces the price difference. Over time, the system becomes unbalanced. What makes the situation unusual is persistence. Short-term arbitrage gaps are common. They close quickly. Persistent gaps indicate friction, regulatory, logistical, or trust-related. They suggest that capital no longer views markets as interchangeable. For business leaders, this is an important shift. Global trade depends on predictable pricing and reliable settlement. When pricing diverges based on geography, planning becomes more difficult. Contracts written at one price may not be fulfillable at another. Hedging strategies lose precision. This affects manufacturers first. Companies that rely on silver inputs must compete with financial buyers and sovereign demand. If physical metal is drawn toward regions willing to pay more for certainty, industrial users face rising costs and supply risk. At the same time, banks and intermediaries face a different problem. Their role depends on facilitating flow, paper against physical, buyer against seller. When physical supply tightens and confidence erodes, their balance sheets become more exposed. They must choose between honoring delivery expectations and managing inventory risk. This often leads to conservative behavior. Institutions reduce exposure, they tighten terms, they favor certainty over volume. These actions are rational, but they amplify the underlying issue. Reduced participation lowers liquidity, lower liquidity increases volatility. Volatility discourages new entrants. The system feeds on itself. It is important to note that none of this requires panic. No collapse is needed. Markets can function under stress for long periods. But stress changes incentives. It changes who participates and how. The global silver market was entering such a phase. Price differences were no longer just numbers. They were signals of preference. Preference for physical control. Preference for jurisdictions with delivery certainty. Preference for systems that minimize counterparty risk. This explains the earlier withdrawal. The movement of 2.7 million ounces was not an isolated event. It was part of a broader pattern, a response to global pricing pressure and settlement risk. Those moving metal were not reacting to charts. They were responding to structure. For observers focused only on Western price action, this dynamic remained invisible. Prices appeared orderly. Volatility seemed manageable. But beneath that surface, the global balance was shifting. Part 3 reveals a critical insight. When global prices stop converging, markets stop being unified. And when markets fragment, physical assets migrate to where certainty is highest. That migration is slow until it is not. The question is no longer whether pressure exists. It is how long the system can absorb it before adjustment becomes unavoidable. They understood that this was no longer just a metal story. When physical silver leaves exchange vaults at scale, the effect does not stop at the commodity desk. It travels outward, into balance sheets, supply chains, credit decisions, and long-term planning. This is where the event becomes relevant for business leaders, entrepreneurs, and institutions far removed from trading screens. Silver is not a passive asset. It is an industrial input. It is used in electronics, energy systems, medical equipment, automotive manufacturing, and advanced technologies. Many businesses rely on steady access to it, often through long-term contracts priced using futures markets. These contracts assume that futures prices reflect real availability. That assumption begins to weaken when physical inventory drains. When 2.7 million ounces exit exchange control, the immediate impact may appear small. The global silver market is large, but the structure beneath it is not as deep as it looks. Exchange-registered inventory represents only a fraction of total annual demand. It functions as a buffer. Buffers exist to absorb shocks. When buffers shrink quickly, shocks pass through the system. For manufacturers, this creates a planning problem. Input costs become harder to forecast. Delivery timelines become less reliable. Even if price remains stable for a time, the risk profile changes. Procurement teams must consider not just cost, but availability. This is where strategic decisions shift. Companies with foresight may choose to secure inventory earlier than planned. They may increase safety stock. They may renegotiate contracts. Each of these actions is rational on its own. Collectively, they increase demand for physical supply. This creates a feedback loop. More physical demand leads to tighter supply. Tighter supply increases the value of control. Greater value of control encourages further withdrawals. Financial institutions face a different version of the same issue. Banks and intermediaries provide hedging, clearing, and financing services tied to commodities. Their models assume that delivery risk is low and inventory is sufficient. When that assumption is challenged, risk management changes, exposure limits tighten, collateral requirements rise, liquidity provision becomes selective. These are defensive actions. They are not signs of failure, but they reduce flexibility in the system. Reduced flexibility means that when stress appears, it moves faster. Entrepreneurs and investors should pay attention to this phase. Major disruptions rarely begin with collapse. They begin with subtle constraint. Credit becomes slightly more expensive. Terms become slightly stricter. Optionality decreases. These changes are easy to ignore individually, but together they reshape the operating environment. Another important factor is confidence. Markets function on trust. Trust that contracts will settle, that inventory exists, that counterparties will perform. Physical withdrawals do not destroy trust immediately, but they test it. Each ounce removed increases the importance of every remaining ounce. Each delivery request carries more weight. Over time, participants begin to ask harder questions. Is supply sufficient? Is delivery guaranteed? What happens if demand spikes unexpectedly? When these questions arise, behavior changes. Businesses with exposure to silver may seek alternatives. Substitutes are explored. Designs are modified. But such changes take time and capital. In the interim, uncertainty persists. From a strategic perspective, this is where asymmetry appears. Large institutions can act early. They have access to information, logistics, and capital. Smaller firms and late movers face higher costs and fewer options. This is not a moral judgment. It is a structural reality. The event described in this series is not about predicting disaster. It is about recognizing early-stage stress. The withdrawal of physical silver is one of the few signals that cannot be faked. Prices can be influenced. Sentiment can be managed. Inventory movement is harder to disguise. This is why experienced decision-makers monitor it. The key takeaway of Part 4 is simple. Physical market stress translates into business risk long before it becomes obvious. Those who wait for confirmation from headlines often respond too late. Preparation does not require panic. It requires awareness, understanding how supply chains function, knowing where dependencies lie, recognizing when certainty is being quietly prioritized by others. The disappearance of 2.7 million ounces overnight was not an isolated anomaly. It was a choice made by actors who value control over convenience. Such choices reshape markets gradually, then suddenly. For those building businesses, allocating capital, or managing long-term risk, the lesson is clear. Monitor structure, not noise. Watch what leaves the system, not what flashes on the screen. Because by the time price fully reflects reality, the strategic window is already closing. Part 4 ends here, not with a prediction, but with a warning. Systems do not fail all at once. They tighten first, and those who notice tightening early are the ones who retain options when others do not.